All right, guys, thanks for joining us today on a Friday. Unenjoyment Friday is what we used to call it on the floor for the unemployment Friday that we have. We call it unenjoyment just because it could be very crazy. But this is a strategy that we can use with a bearish market assumption. And Rich pointed out at the beginning, is this strategy reflective of my overall market assumption? And really what I mean by market in this sense is the underlying. So, even in a bullish market, we could be bearish a particular underlying. Maybe if the market's doing very well, gold could be going down or crude oil. So that's kind of like the market I'm talking about, the underlying. So a particular underlying. Maybe you're bearish Apple or something, and that would be the market we're referring to. But anyway, a couple things to get out of the way. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, for my commentary on everything from economic to geopolitical and market analysis. And I have been trading my own money for well over 20 years now. And I'm not here to tell you that I'm going to make you rich or make you a millionaire, but I am here to help you take control of your finances, manage your own portfolio, but most importantly, take control of your own risk. Rather than paying somebody else to take control of your risk, you guys, do it yourself, or at least start another little account where you can judge your return on investment compared to theirs. Anyway, I've been trading my own money, like I said, and I've traded in most markets throughout my career. From the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodities, and currencies, with options on all of those products as well, and in all market conditions. As you can see, that could very well have been an unemployment number, but I think that was a FOMC day. I got a disclaimer I got to go over. This basically says any opinions, news, research, analysis, or other information contained here are material provided by Pro Trader Strategies and associate companies or employees, is to provide general market commentary and does not constitute investment advice or solicitation to buy or sell any of these types of securities that we're talking about. The reason why I can't tell you guys a particular strategy or particular underlying, even more importantly, to implement into your portfolio, it's because I don't know your risk parameters. I don't know what's in your portfolios, and it really could be counterproductive for your portfolio and or might exceed your risk parameters. So take what we teach you in these different webinars and do a little soul searching and see if it's actually appropriate for you before implementing any of these things. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, so last week we did the call diagonal. This week we're going to tackle the put diagonal. And I know it was pretty heavy last week with the calls, and the calls are actually much more difficult to create this strategy around the rules that I try to follow, because usually when people are hedging a portfolio, they're selling calls, and when they're hedging their portfolio, they're buying puts. So that's what makes this a little bit easier. When they're buying those options, it has a tendency to inflate volatility in that particular strike and or underlying, and makes this strategy a lot easier to find underlyings that will fit with all of the rules. I know last week a lot of people got a little frustrated with all the math and everything else. We're still going to go through the math, but the trial and error of finding the right one hopefully will not be as arduous. Okay, so the assumption for this one is going to be neutral to bearish. Now, yes, we are going to be buying a put, and so that's what makes it bearish. But we're going to be selling a front month put to help finance the extrinsic value of that options contract, and I'll go into that in a little more detail a little later. But that's what makes it neutral, is because we don't really want this to immediately be our directional bias, or at least not exceed our short put there. So we would like this to go down. Problem with the sound? Scott says the audio. Is anybody else having a problem with the sound? John says it's okay. Dennis, you're saying no, sound is okay or not okay? Okay, okay. Maybe if you log off and come back in, everybody else is seeming to come on here and say it's sound okay on sound. A lot of people are saying they're getting good sound. I do have a raspy voice, so don't let that throw you off. Okay, good. Good, got loud and clear. Okay, let's start again then. So the reason why it says neutral here, in a sense, we are bearish because we're long a put. So obviously we would like it to go in that direction, but we really don't want our short put to go into the money. And in that regard, we want this to kind of be sideways and then start coming off at the end or after our short put has expired worthless. So that's why I have it as a neutral type scenario. All right, so the put diagonal to set this up, and you know, when everybody talks about it, everybody talks about buying the further duration option first, and that's really because it is a debit, and then you sell the out of the money near expiration. It seems to me that what we're doing with this one is we're trying to sell the option, and then we're looking to the further duration option that we're buying to pay for that extrinsic value. And if you're not familiar with intrinsic value and extrinsic value, when options are in the money, they have intrinsic value and extrinsic value. The in the money portion of, say, a particular strike has both of those. We want time decay to happen on the out of the money ones, and that's why we're trying to finance that. So if you have an 85 strike, let's say, and it's for $5, and the underlying is trading at say 82.50, you know, $2.50 of that is intrinsic value, $2.50 is extrinsic value, because to get to that 85 strike to where the option or the underlying is trading is intrinsic value, and all the rest is extrinsic value. So keep that in mind. So when, and all out of the money options are consisting only of extrinsic value. So what we're trying to do is use this out of the money put to pay for the extrinsic value of the in the money put. Okay, does that make sense to everybody? All right. All right, so essentials to success is picking the right strikes. Now, what we're going to be looking for, and generally the way this sets up, is the put that we're buying that is in the money is usually right around an 80 delta, and that's where I like to do it, because it seems to give me a lot of room for error when we do that, because the extrinsic value is allowing us to get further out of the money with the one that we're selling. Okay, so obviously we want to try and make sure that our extrinsic values are covered in this. And the further deep in the money you go, the less extrinsic value that in the money option has. The closer to at the money, they're going to have more extrinsic value. You can think of extrinsic and intrinsic value as intrinsic is what is built into the option to get it to where the underlying is trading, and extrinsic is all time decay or fat, if you will. All right, so in picking the right duration, so what we're trying to do is pick something that has a duration that is going to have more theta decay than the one that we're long. We don't want to see our long put decay, so that's why we're going further out in time. This is the decay of options as they get closer to expiration. So the one we're selling, we would like to see this really accelerate, but the one we're buying, we want it to have less decay. So we're going to be buying something out in here and then selling the one that's kind of closer to this acceleration in decay, because that allows our one that is out of the money to decay quicker on that extrinsic value than the one that we are long. Okay, so that goes back to all of that extrinsic value. So the one that we're selling is all extrinsic value, and we want to decay all of that extrinsic value quickly to the one that we are in the money that has extrinsic value. We don't want that to decay as fast, so that allows us to be profitable longer. And picking the right environment. Now the right environment with this, usually we're talking about just low volatility, so that is key to this, something below a 30 IV percentile. And usually when I'm selling options, it's somewhere above 50. This one works best right there at around or just below that 30 IV percent. You can go all the way to 0 really, but we want low implied volatility because if volatility expands, that actually helps us, because volatility expanding will pump up premiums in our short one, but volatility affects longer duration options more than it does the closer duration ones. So we would like volatility to expand over the long haul here. And the other thing is, with the right environment, we also want these two different expiration cycles to have relatively close IV. Trevor's asking as I'm talking, yes, low IV in the front or the back month. We want it to be low in general, below 30 IV percent for the options contract. But we also want the, I'll just pull it up real quick here. Hopefully I have it on the right one. So if we're going to be looking at something like this, so this is in that wheelhouse of the option I was talking about, 45 days. That's where this slope really starts picking up. Let me see here. There we go. So this 45 days is right in here, so, or 41 days to expiration. So we're getting into that cycle of the wheelhouse of this really picking up. So that's the one we're going to be looking to sell, the out of the money. And then the end in the money is this going to be this August, which is the next monthly expiration, 76 days. So you can see this slope is much slower out here at 76 days than right here coming into this 45-day period. So that's what we want. 50% of theta decay happens right in this area. So this will have a slower decay of these options premiums. And then the right environment, what I was talking about, and Trevor was quick on his toes, we want this to be somewhere close to about 2 percentage points away from each other. So usually the further out in duration you go, the volatility will expand. So, but we don't want this to be like 13 and this to be 25, okay? Because then these options premiums are going to have a lot more extrinsic value. We'll have a lot more extrinsic value than these will. Because there's more volatility. Volatility pumps up those premiums, and if those premiums have more extrinsic, a lot more extrinsic value than these do, this strategy will almost never work. So the closer these are in volatility over here on the side, you know, I like to try and hit it right within 2 percentage points, but you know, it's give or take a little bit. That is kind of the wheelhouse you're looking for. And then you don't really have to go through all the math. If these are like 5 percentage points wide, this was 1365, this was 1877, then you're almost assured this strategy will not work with that kind of setup. So you don't have to go through the math that we will be doing when we pull this thing up. All right, so and picking the right underlying, something like Apple, the major ones that are trading, the reason why is because you want a lot of participation there, volume and open interest, because the ones that, the further in the money you get on these options, usually the wider the bid ask is going to get. So even though the out of the money ones are pretty tight, sometimes you'll see the deep in the money ones or the in the money options be wider. Having said that, in something like Apple, the Teslas, the ones that everybody is always talking about or looking at, even though those in the money options look a little wider, you can just, step in above the bid and usually have a pretty good opportunity to get filled a couple of ticks. Maybe 25 ticks wide or 25 cents wide, but you might be able to outbid the bid by 5 cents and get hit, especially in something like Apple. All right, and then knowing our exit strategy before entering this trade, and this is something that is very important with any trade, right? Our risk is limited because we're paying a debit, so that's the most we can lose. But where do we get out of this strategy? And usually what I'm going to do is look to get out when our position has reached 50% of max profit potential, which means if we have a $10 wide spread, going from like the 80 strike that we're short to the 90 strike that we're long, then that's $10 wide. If we paid $7.50 for it, our max profit is that $2.50 that's remaining, the width of those strikes. I would look to exit this at $1.25 profit. All right. I know that's a little confusing. We'll go over all of that in a little bit, but looking for 50% of our max profit. If we pay $7.50 for a $10 wide spread, our max profit is $2.50, which is that difference. I'm going to look to exit this at about $1.25 or half of that. If it starts going bad, if it starts going against us rather quickly, if we paid $7.50 and this started getting closer to maybe $3, that's kind of like where I'm usually to just kind of pull the ripcord on it, be like, I'm out. But a lot of times I will let this strategy run out. The other thing we can do is, if this goes against us, we can take that short put off for almost nothing, and then just let the long put ride it out. It's one of the very few times I will leg out of any strategy. Usually I don't leg out of strategies, but if that short put is basically worthless or worth less than a nickel, then I might just take that and pull that one out, be done with it, because I can't lose any more than what I already paid for it. That short put is no longer helping me, then I might just take that off. The other thing you can do is roll that put closer to at the money, collect a little bit more credit, and lower your overall break even on that. So having said that, max profit, like I said, is the width of those strikes. So like we talked about, the $10 wide minus the net debit. In that example I said was $7.50 equals $2.50, which is our max profit, $2.50. And keep in mind, the max profit is considered really unlimited because of the different expiration cycles, meaning that if we let that short put expire worthless, then we're left with that long put, and the underlying could go to zero. Is that likely to happen? No, but it's kind of where the long put strike is to zero is really, where your profit potential lies. And volatility will affect the max profit on this. As volatility expands, our max profit could actually increase with the width of these strikes, because like I said, it's going to affect the further duration, and that volatility will pump up that premium and that further duration more than the shorter one. And then our max loss is always the debit paid. With any debit paid, that's the max loss you can have. And even though these are different expiration cycles, that's still the max loss that we can see. And our break even, and this is important, is our long put strike minus that debt or that net debit paid. And volatility can affect this as well. But remember, we subtract the net debit paid. So when we do this, we always want our break even to be above where the current underlying is trading. That way, if your break even is below where you are, in order to achieve break even, we have to go down. Whereas if the break even is above us, then we're already setting ourselves up for success. If our break even is below us, we're starting to set ourselves up for a loss on that. So this is usually where I go into where you guys can throw me out some examples of stocks that you like to trade or that you're bearish in that underlying, and we can look around at it and see if it actually fits the parameters that we're talking about. One of the things that we want to make sure with this strategy is that when I gave that example of $10 wide and we pay $7.50 for it, we want our ratio to be 75%. So that's, a $10 wide, we pay $7.50. We want to make sure it is $7.50, 75% or less. Sometimes you can see this strategy actually, if you get a big discrepancy, especially in these volatilities, that the spread is $10 wide and you're paying $10.25. They want, it's looking like you're going to pay $10.25 for it. That means there is no possible way to make money on this. You're paying more than the width of the spreads. So you could be paying over 100% for the width of those spreads. And believe me, it does happen. I've seen it before, and you would never want to do that. So always take what you're paying and divide that by what the width of the spread is. And if it's less than 75%, then you're good to go. If it's not, then you want to pull out. The next thing is after you go through that and figure out the width of that spread, then you want to go through and make sure the break even is above where you currently are. So if we were going to buy something at the 105, we want to make sure that our break even isn't down here at like 290 because, or sorry, 2090, because it's trading 2099. Our break even is $9 below where we are. So that happens also. So those are part of those rules that I talked about. All right. So, oh my gosh, somebody's bearish Apple? That's blasphemy, isn't it? I'm just kidding. I mean, I'm bearish Apple also, so in general. But let's look at Apple. That was the first one that came up. So, I think it wants to come up. Let me close that out so it doesn't confuse anybody. First thing I'm going to look at is the IV percent, which you scroll down here, it's right down here. 5%. That's good. That meets that rule. This is also a chart of it where you can see this is the blue is the IV percent, or where the current IV is. IV percent is basically just a mathematical equation. But we want low IV percent. They do it for us here. The next thing is we want to make sure they're relatively close in volatility, because the last thing we want to do is see this volatility to come off more, because if that volatility comes off, then that means our extrinsic value starts decaying quicker. How does the strike you sold relate to the price of the stock, the delta? Usually I mentioned the 80 delta, somewhere in the 80 delta, because that's usually where it gives me less extrinsic value. This is the extrinsic value of this particular option, or it's very close to it. It might be within a nickel or a dime. But, that's a quick cheat that we would use on the floor is if you're looking at puts that are in the money, if you go straight across to the corresponding call, that is what the extrinsic value of this option is embedded in there. So like if you took 73 cents away from the $13.10, that would give you $12 and let's just say 60 cents. Add that 12.60 to this, that would give us we would subtract the 12.60 from this. That would give us 97.40, right? Is that right? on the math, but that's kind of the idea there. So like doing that math is kind of a pain. If you just look at it, the extrinsic value is kind of there. So then if I was to look at doing this strategy with the 105s, or say the 110s, just to stick with my example, then I would need to look down here and finance that 73 cents. So, you know, like the 81 calls here, or the 81 cents there for the 92.5. So in that regard, I was looking at the 110s. So I would go to buy these and then go down here to the 95s, control to sell. All right. So we're assuming we paid for our extrinsic value to extrinsic value. The 81 cents should cover that extrinsic value, right? The next step would be to look at the width of these here, and we have 1750, right? So we need to pull up our calculator. We got 1750 as our width. $17.50 is the width of these two strikes. So we take our $12.38 and divide that by 1750, and that gives us 71%. So that's good. That meets our criteria. That's below 75. The next thing to look at is if we subtract this $12.38 from our long put, we want to make sure our break even is above where we are currently at. So if we take the 110 put that we're long and subtract that $12.38, we need to make sure it comes out to somewhere above where it's last trading, and it's not. And the likely culprit is because this is just over 4 percentage points wider. So I mean, I probably could have told you that before, that it wasn't going to work out. That's because there is, you know, it's a product of the volatility being embedded in here more so than in here. And it doesn't allow you to get further out of the money because these are, the volatility is pumped in here and not in here, so it doesn't allow you to get far enough away. How does the strike you sold relate to the price of the stock delta? Oh, I think I answered that one, no? Trevor, $17 wide, that would give you a lot of room to be wrong in this, right? Yes, it would. It would give you a lot of room to be wrong, but you're setting yourself up for failure on this because, you know, there's better setups where we could even get further and give ourselves even more opportunity to be wrong. You know, we would almost rather be a tick down here in order to be wrong, and then, you know, make it a little bit tighter also, because if it goes away, you know, you're laying out $12 for this strategy. That's a lot of money to be laying out. And another thing with this is, if you're used to doing bigger quantities, I would shave that quantity, especially when you're first implementing this strategy, and go to your lowest tranche, if you will. You know, if you do tranches like you know, 5 lots here and there, and do price discovery with that, then maybe go to like a 1 or a 2 lot. Okay, does give you a lot of room to be wrong, but it also gives you a lot of room to be right. Well, I mean, so anyway, the probabilities of that one being in the money are quite high, which is the delta, and that is the thing we're looking for, is the delta. It means it's an 80% chance probability of being in the money at expiration, which is a good probability. All right, so some of the other ones were TSN, and I don't trade TSN a whole lot. It's got $10 or 10-cent wide, which for $60 stock isn't bad. Usually my parameters on the width of the bid ask is $10 or 10 cents wide on anything under $100. It's got to be within 10 cents there, and that meets that parameter. The one thing is it doesn't give me that August option. You know, you could go to the weeklies. That doesn't give you a whole lot of time, and to go that far out in October, it's going to make us go really deep in the money because of all the extrinsic value embedded in there. The further duration out, you're going to have, John, I don't have a scan criteria set up for this other than I just usually look over here on my watch list and just start going to the low ones and start clicking on them like this. And I have it connected to this, so when I click over here it automatically gives them, and I just look for that. So Costco is right there, very close to being only $2 wide, just as this is an example. And you there's a lot of trial and error with this one. It's not like just setting up an iron condor or a put spread or something like that. There's a little bit more that goes into this one, and it's a little bit more labor intensive, I guess, if you will. And Costco being, you know, $150 stock, this is going to be an expensive one no matter what we do. But the 80 delta-ish, if I could get $1.62 down here and be farther away, you know, the only way I could get $1.62 is being right there. And I only have $1.71 to really be wrong. So, and if I go further away, yeah, that one wouldn't fit it. So let's look at Joy Global. And again, Joy Global doesn't have the August contract. So when you skip out like that, it really makes it difficult if you don't have that August contract in there, because you have to go so deep into the money to be able to finance that. And then when you do, you're really close to the money. So, you know, you would have to almost go this deep in the money. See what I'm saying? And then you're at $1.25 wide. That's a pretty wide bid ask for a $20 stock. That wouldn't work for me. The further duration out, this is the further duration. Further expiration has longer time, duration being time. All right, so anybody else have any more examples? I could start jumping into a couple examples that I had found or were looking at that kind of were examples of that may or may not work. So like something like Disney has a lot of volume and open interest. I mean, it's a $100 stock and it's 4 cents wide. That's really good. That means that once we get out here, even though we get into the money and it looks like it's 15 cents wide or 30 cents wide, there's so much participation in there on a daily basis that that somebody's going to be willing to give up the edge. As you can see, even the ones that go into the money have participation. So somebody will be willing to play on these options. So looking at this one, we could look at, like, say, the 105s in August. We're going to look to buy. And you could always look at the charts too and determine where your risk is on this. Like, you know, I don't want it to go you know, above 105 or something like that, or you know, or 100. So I'm going to buy the 105s there to make sure that I stay in the money. So if you do that with support and resistance, you can just go back after you look at it and say, okay, these 105s are looking like they're going to be the best ones. The 105s, 110s are that 80 strike, but we can look at this one because they are within, you know, close enough to 2%. It's off by a couple tenths, but we'll go with it. So the 105s, if we were looking to buy that one, We have to finance this 90 cents. So I'm going to probably go to, this 95. All right. So the next step is then to pull out the calculator and look at it again real quick. Pull this out, clear it. So we got $6.59 divided by the width, which is 10. And we don't even really need to do the math on this. It's 65%, 66%. So that meets that criteria, right? The next thing to do is subtract this from the long put, which is the 105 put. So we take the 105 put, we subtract the credit, or the debit we're paying, and it needs to make sure that that's our break even. And is our break even above where it's currently trading? No, it's not. Trevor's asking, how do I select the out of the money put? The out of the money put I select by making sure it covers my extrinsic value. This is the extrinsic value of this option, give or take 10 cents or so. I mean, usually it's usually a little bit more, but that's the quick look at, so you don't have to like do the math and figure it out. Really, the way to figure out the extrinsic value of this option is to take the 105 strike and subtract the $7.50 from it, $7.50, and that gives us $97.57. So that's where you then look at the difference there is the extrinsic value. So that's saying it's $1.25. I don't know why that's not doing that, but it's a little bit more there. Usually they line up pretty good. This one's not doing it. So $1.25 is what the extrinsic value of this is, which is why, if that's the extrinsic value, this isn't paying for extrinsic value, and that's putting the break even below the current market. How often, we tried 4 different candidates and each failed the conditions. How often do these diagonals occur? How often do they, I took about 20 minutes just kind of running through them. Usually you can figure out right away. I'm showing bad examples also in order to set you up for some of the good ones. I know what the good ones are, to be quite honest, but I'm trying to show you how they don't work. It's easy to show you the ones that work right away because I've kind of looked at them already. As a matter of fact, I can pull up this one here. Let's look at target. So we'll get into the good examples because we are running tight, and we want to delete this one. Wait, why did I think target worked? Oh, you know what I did with target, because it was they didn't have the August ones, and these were pretty close to being in line. Target worked out. You can go to this one because you're going to get a lot of theta decay rather quickly, and with target I went in here and started looking for the 80 delta, and so if we buy this one, I look at this to say, all right, 44 cents here. I need to at least cover that extrinsic value by selling these, because those probably wouldn't cover the extrinsic value. So then selling the 67.5. All right, so make sure you do your quantities. Not that it changes the price at all, but just so you're sure of it. And we're looking at this to be $3.70, right? And it is a $5 wide strike. So, I can tell you that it's going to be about 74%. Let's see, where's my calculator? Did I close it? Shoot, I close my calculator, sorry. So take the, oops, $3.70 divided by 5.74. All right, so 74 meets our criteria. Would you continue to select the in-the-money strike until the diagonal works, or do you just go on to another stock? I usually just go on to another stock because at the end of the day, it usually means that I am going to have to be closer to at the money on both of them. And then you're kind of doing a calendar spread, like a call or a call or a put calendar. So this one I'm trying to get in the money a little ways so that I can increase my probabilities of being in the money at expiration, which is you know, an 88% delta tells you the probabilities of being in the money, and then like a 32% probability of being in the money. So it's usually somewhere in between 20 or something. So that fits that. 74% makes it. The next thing to do is take the $3.70 and subtract it from our long put, which is the 72.5 put. Oops. 72.5 put minus the $3.70, 68.80. So now our break even is above where the current underlying is trading. That fits the parameters. We got our 75% width of the strike. We got a 68.8 break even. That's, you know, 20 or 15 cents above where we currently are. That's a good, you know, now that's a good setup. This is, you know, inside of that 2% the widths. So that works out. Another one that we could do is this is an example of where when you find it that the options have almost the exact same volatility, and in this regard it's actually going lower. As a matter, this one's a little bit wider, so I think in this one I went with the June July also, or July June is actually the proper way, because this gets a little bit further away. So if you really are kind of bearish to the underlying, you can always look to do that as well. Where, you know, with BABA, you're going to have to go pretty deep in the money here. But you could look at this one there, and our extrinsic value on this is about $1.39, so I need at least cover that. Control, hold that down. We have an example. Okay, so $7, so what is that, $13.50? I'm sorry, $12.50. $12.50. Final answer. Yes, the recording will be sent to you guys. One thing I always say is make sure that watch this again, because I know this could be confusing and go by people rather quickly. So we got $12.50. We got an $8.32 divided by 12.50. 66. That makes it our break even, though I think is going to be off. Why do I keep hitting that one? So our $85. Subtract that by the $8.37. So break even going to be there. It's right there. So that would fit the parameters. I mean, it's 1 penny above, but you know, that's a win. I mean, it's as long as it's equal to or greater than, it's right there. You're at least setting yourself up for success when the break even's, you know, where you are or above where you are, because you want your break, you're in a sense in the money at that point. So that one works out, even though that's a little bit longer, that, you know, it's 3 percentage points wide, you know, it's give or take a little bit, and that works out. The other thing you could do is, you know, if you ever see it where the volatility is higher than it is in the further duration, then you can almost assure yourself that you are setting yourself up for success. So in that regard, you know, if we were going to look at the one where this is a higher probability because this has more extrinsic value than these do in the terms of volatility, we could look at the what is that? What is the next? Which ones did I have for BABA? For BABA, I think I was going to do the, so look at this 80, my option. This is, let's delete that one. So with this, we could be looking at for BABA as the 82.5, I'm thinking. 82.5 because that has 85 cents. That's close to that 80 delta. We could probably even get a little bit further away, but we're paying at $3 more. So that's why I would go with that one. You know, even though we're, you know, have less extrinsic value by 40 cents, I have to pay $3 more for, you know, the $2.50 wide. You know, it's 50 cents, $2.50 different, paying $3 more, almost $2. It's close. It's kind of a pick 'em there, I guess. I just don't want it to have the extrinsic value not make up for the difference there that I'm paying. Looks like it's pretty close. But anyway, so 85 cents. We want to at least pay for that 85 cents. We could probably go to this 74.5 and have that work it out. So $5.71. Again, we go back to the width of these is $7, right? Did I do that right? Oh no, that's $8, isn't it? So we do the $8 wides minus the $5.71. Oh, I did that backwards. Sorry, guys. I was trying to read while I was doing this. 571 divided by the $8.71. So that fits that parameter. If we subtract the 82.50 from the 571, 76.79, that's above. So that one would work as well. So there are a lot of examples that you can find that it will work. And the best thing to do is to set your strategy up where you have the IV percent on the side here and just start at some of the lower ones. I do find that it seems to work a bit better on the when you get into the teens for some reason, but that's for that. For these diagonals, can we have debits that are in the $2 and $3 range versus $8? Yeah. So I'm picking stocks that are, you know, I've been picking stocks or had the tendency to be able to only find the stocks that are a little bit higher in value. That's not always the case. But, you know, if you want to not pay that much to get a $2 or $3 one, you're going to be looking at the ones then on your watch list that are somewhere in the $38 area. So like Chicago Bridge, for instance, is in that $30. So we wouldn't be having that same problem. They don't have the August. It's, you know, a little over 3%, but we could look to see if it works. 45 cents is right there. That looks pretty good. So that one, but, you know, it's 15 cent wide on the $30. Well, we'll just look at it anyway. That's the bid ask is 15 cents wide for this. So it's probably not necessarily the one that I really want to do. 42 and a half. 42 and a half, we got to try and at least pay for 45 cents. So I would probably have to go to here because, oops. Okay, so then go through that. Now we're looking at $5.50. I can tell you right now that's going to be like about an 89%. So that one wouldn't work. All right, so then you'd have to just kind of go and look for something else. Maybe Dow Chemical. I think they have pretty tight markets. $7 cents wide. Can you go over the IV in the front month is higher than the back month? Yeah, that happens. It's very rare though. Usually there's some kind of event. Baba just had some kind of news out, I think it was yesterday, and that's probably what pumped up this front month. It probably has more volatility because it's going to be a quick, closer duration type issue. I can't remember exactly what it was, but that can cause that. And it is a very rare occasion because volatility affects the further duration ones more, generally speaking. But this one comes in line with that rule. It's, you know, about 1% away. So we could look at doing the ones that are a little bit closer now because we got 49 cents. Nope, I'd have to go to this one. It's still not gonna, it's not gonna work out to meet your parameters, Trevor, because we would have to sell something like that. And that's still going to be in the $6 range. So you're going to have to do it with the ones that are a little bit, maybe KMI. So KMI, you know, so here we got 30 cents. That's a little bit wider. So see, you can see that we can't finance that one. So keep just scrolling up and keep looking for them. So Whole Foods, let's see. Whole Foods looks like it could meet that parameter. So 30 cents. So this one will work. At least it looks like it on the cover. Hold that down. $2.03. We've got a my brain's going dead. $2.50. Ooh, that's going to be close. So let me pull up this calculator. I almost pulled out my other one. So right here we have $2.50 wide, $2.50 divided by 2.03. I did it backwards again. 2.03 divided by $2.50. 81. No love. You try Bolt Day. They have usually pretty tight markets. They have the August contracts. Nope, no August, but you could do it where we could probably do it with this one. So we could buy the 20s, sell the it's not going to pay for it. You'd have to go pretty close. I don't like going to the ones that are just out of the money, so I'd just move on. So it does take a lot, you guys, to build out this strategy, and it takes time, but you know, that's part of making sure you're successful with this strategy is making sure that you are doing your due diligence. And that's really all it comes down to with anything. It's you know, one of the few things that you can control with trading is your order entry, especially with options. And this is one of those things that really has to have a close eye on, is making sure that you are trying to set this up for success, and that's all at order entries. Sophie's saying USO, all right, cross your fingers. Let's see it. It's got August. Oh, you know what? I think I was actually looking at this one too. You're right. I think this does work out. Okay, so we have right there at 2% the width. And for bearish oil, you know, today was a little strange. You know, at the beginning, somebody was asking, do I do this round market assumptions? The dollar got pummeled today and oil still came off, which usually, because it's dollar denominated, that oil's really been pretty strong lately. It could be meeting its end, plus its end of its rally. Plus there's so much oil out there. It's ridiculous. So we'd have to go to like 13 strike. So let's look at buying, because I'm just right now when I'm scanning through this, the reason why I'm picking this 13 or 13 and a half strike is I'm looking over here to the extrinsic value and then looking down here to get a little further away, because I don't want these 11s to get hit right away. So something along, so I'm just kind of going up here and looking at the extrinsic value in relation to those down there. So let's look at the 13 and a halves and then sell the 11s to finance that. So again, here we have $2.50 wide with a $1.63 debit that we have to pay. So if we look at $1.63 divided by $2.50, 65, that makes it. We also said we got that in line with our volatilities here and our volatilities here within 2%. So the next step is, since it meets that criteria, is our break even going to be above us? So we take our 13 and a half strike to find out our break even, 13.5 minus the $1.63 we're paying. And let's see, is our break even above us? 11.87. That meets it. Great job, Sophie. Thank you. Yes, and the Saudi-Iran OPEC battle. They're just not going to cut off this spigot. They're just not going to. So that's where you would find that. And, you know, I might end up going ahead and doing this on Monday if it's still working out. And, you know, watch the daily market commentaries because I talk about them, the trades I put on and stuff like that. So, and I'm bearish oil, so we can look at the chart of USO or /CL. One thing I've been saying, and on different outlets, is that as long as oil stays below 50, it is looking to be, here's my oil chart that I've been watching, is looking to be bearish. The bears have got to get above this psychological $50 a barrel area. This is really resistance, but if it gets above 50 and settles above 50, it's going to look to want to trade to 60 and fill in this little gap here. But if the bears start taking control, it's definitely going to want to come down to here, and this is where most time and volume has been spent, which means that is where price has been accepted, which means that it's going to want to go down there. What is the 60% again? I think the 60% was the, we look at the trade that we had, CL was USO. So USO, we did it, the 60% was where the width was. I think it was like 64 or something like that. So we bought the 13 and a half strike, financed it by looking at the extrinsic value, which was around 30 cents, or 20 cents. So we sell that one. It gives us $1.63. The 60% was basically somewhere around $2. I almost did it again. The $1.63 divided by our $2.50 gives us 65%. It means that the debit we're paying is 65% the width of the strikes. So we don't want to pay more than 75% the width of those strikes. And in some regards, you guys, if the back month has even more volatility, you can see it where you've got a $5 wide strike and you are paying $5.10, which means you have no possible way of making money unless you took off the short put early and then you were directionally right for a long duration. That would be the only way that could end up being possible, but you could never take it on or put it on as a spread and take it off as a spread and be profitable, no matter what happened. Does that make sense to make sure? What happens if USO goes less than 11 at expiration? That's a great question. This will be in the money, and that is true. But remember that these are going to be going deeper in the money, and since we already paid for the extrinsic value of these, this is going to go up in value, but these are going to go up in value exponentially more, because the further deep in the money these goes, this delta, okay, so delta, we got to talk about real quick with this. For every dollar move lower that USO goes, when USO goes from $11.82 and we're directionally right, and it goes to $10.82, which is what Sophie's talking about, that means this goes into the money, right? This option will go up by $79 for that very first dollar that we go down. 79 cents goes into this value. The first dollar that we go down in this option, we go from $10.82, down to $10.82, which is $1 move down. This option increases by the delta, which is 25, and it's an estimation, you guys. So it would go to 50 cents. So we would be profitable by about, if we subtract those two deltas from each other, by 54 cents. Does that make sense? Well, what about assignment for the one that's the short? Yeah, at the end of the day, you could get assigned on it, but you still have this put that you could assign somebody else on. Does that make sense? So even though that these start going in the money, and that's why we're directionally bearish, we don't really care. The best scenario would be it just slowly trickles down for the next several days, and these start expiring worthless, and then we get our fall. That would be the best thing. But keep in mind, if this does go into the money, the deltas will always be greater on your in the money ones than they are on your ones that initially started out. These deltas will never go and really go over these unless it moves really fast and very dramatic, because then you're going to get volatility in there, and if you go way in the money and this goes like to zero, then they're going to be they might be far enough into the money where the deltas aren't going to be offsetting each other as much. Does that make sense? Better than the 13.5, 11 spread. I don't know, Sophie, what you're saying there. I think that this one works out as one of the better ones. You could go and pay a little bit more and do the 14s, and you're going to get, or the $14 ones, but I think our break even is going to end up being below us on this. Did it work out? 14s and 10.5s. So we subtract 14 by 7, so that's 1183. So that one would work too. So like if you wanted to get further out, I just did that math in my head just to make sure 1183 is the break even. So that one works out too, where we're right at the break even. So I would be okay with that one too. To get a little bit further out, you're paying a little bit more, but you also are increasing your probability of this being out of the money at expiration. Uh-oh, huge oil train derailed and fire in northern Oregon. Oh, oil should be up like $3. how many barrels of oil are each one of those tankers. I don't really know, but it can't be, I think you need to get up into like 800,000 barrels or 500,000 barrels in order to really start affecting oil prices too much. Look to close around $2.40. So good question. If our width of the spread is $3.50 and this is $2.17, our max profit is going to be $1.33. So wait, did I do that right? So the width of the spread is $3.50. $3.50 is the width of the spread. Max profit is $3.50 minus the $2.17. That gives us $1.33. So half of $1.33 is going to be around 70 cents. That's when I would look to close it. So, you know, when you're getting a total credit of $3, let's say, somewhere around in there is when I would look to close this. Does that make sense? Because, you know, my max profit is $1.43. Is that right? $1.43 is our max profit. And if I'm going to take around half of my max profit, that's about 70 cents. So when this is trading at $2.80 some cents or $2.90, that's when I would look to get out. Because you add what, you know, if you're paying a debit, you want, in your max profit, you have to add that into the debit. So you're collecting more than what you paid. Does that make sense on that? Half of what my max profit is. Good. All right, well, we've gone a little bit over. I appreciate everybody like sticking around late on a Friday, as always. One thing that we have an offer going on that, somebody blew up my thing. There was a lot of quick comments on one of your other strategies videos. Stated that I don't have enough time to read this, Chris. I'll try and read this after we get through all of this. Anyway, so anyway, let's go back to this. This is a special offer where you get like for $36 you can get all these different videos, and basically you can show you how to set up your option screen, kind of like mine is. You know, everything is setting yourself up for success, you guys. So make sure that you do that. This is also the web page so that I can scroll down on it. So it shows you how to set up your screen, how to use those delta measures. There's 5 different things you can do with delta, and I go through all of those different things that delta tells you on that options chain, so you can know your probabilities and everything else, and how decay is going to affect you, gamma, and the history of options, all of those different webinars you can get. Plus there's also another offer on there for $7 for people that participated here. So you can go to protraderstrategies.com and sign up for that. If you don't want to copy this link and try and write real fast, write it down, should be in the chat box there to the side, not in the questions box here, but there is a link there in the chat box. The other thing you can do is you can just reach out to us at ProTraderStrategies or trading at ProTraderStrategies.com, or you can call us at 310-598-6677. Another thing, you guys, if you guys signed up for all these classes and everything else, and you're trying to do these trades on your own, and you have a question about any of the strategies I've ever gone over, or one that you've implemented, and you want to know my rules around what to do to defend it and when to take it off and stuff like that, please reach out to me. You know, you can email us I'm good about getting back to everybody on their questions that they have for me. So please feel free to do that, and because I want you guys to be set up for success too. So and another thing is you can email us if you have a webinar that you want us to do on a particular strategy that I may have missed along the way there. So if you think there's a good one, let us know and we'll be happy to cover that. All right, that's all I got for you guys today. If you can't take that, take it easy and have a great weekend.